I want to just briefly go over some of the stuff I'd introduced last time. This was our first time actually looking at some of um, this idea of capital structure and the way that it affects the payoffs, the post interest earnings of the firm, which then if the firm is paying its bondholders first, the firm is paying its debt obligations, paying its debt service first, and then the earnings that are left over after it does that, um, those are available to then distribute to shareholders, and so that makes shareholders happy. Um, and the we looked at a brief example last class, which I'll review this time as well, about how the 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 um, the substitution of equity with debt, substituting debt for some of your equity, increases the risk and return profile of the earnings. And so that was this key example that we looked at on this slide here, where we were considering two different capital structures. One of them was completely equity. All the $8,000 of assets were financed by the owners of the firm or the shareholders of the firm themselves. We looked at an alternative structure where half the equity or half the assets were financed with equity, half with debt, and we considered the implications of that for specifically earnings per share. We saw that there were different states of the world which produced different earnings numbers. Under normal conditions, earnings were $1,200. Under particularly good economic conditions, earnings were $2,000. Under bad economic conditions, they were only $400. And in each of these cases, we could consider what the returns, what these earnings represented as a percentage of the overall assets of the firm. So these different states of the world represented 5% return, 5% return, 15% return, and 25% return, respectively. And these represented also different numbers of earnings per share, which, if you think about earnings per share, those are cash that's able to be distributed to the owners of those shares, or the equity holders. And so these are sort of free cash that is able to be distributed to equity holders. So more earnings per share is good for an equity holder because they have more cash available to them, depending on whether it's worthwhile to pay out that cash now, or whether they should invest it back in the firm, which is a separate decision. But we're going to just use the fact that more earnings per share means that you could distribute more dividends if you wanted to, which is good for shareholders. So those were, you had $1 per share, $3 per share, and $5 per share under these different states of the world. Oh yeah, so there's a question in the chat about return on assets versus return on equity. Yeah, let me, assets, if we remember, these were $8,000. That was assets. The earnings are given by these numbers in this top row. So if you have earnings of 1,200 and your assets are 8,000, then that's a 15%. You're earning 15% of your assets in this particular year in which you're operating and conducting business. Assets in this case for the unlevered firm, these are equal to equity. So again, you just have $1,200 of earnings over $8,000 of equity. So it's the fact that in the unlevered case, assets are equal to equity, and so the return on equity, or the earnings that are available relative to the amount of equity, is the same in the unleveraged case because assets are equal to equity. So that's true for this this unlevered case. That's definitely true here. what's not going to stay the same is then when we take this example and then we translate it into the case where the firm is levered up. So in this case, we have a proposed capital structure of 4,000 debt, 4,000 equity. So now we have 4,000 debt, 4,000 equity. Assets are still 8,000. That's just the sum of the individual components. So return on assets, nothing has, so the key point here is nothing has changed about the earnings potential of the firm. The firm is still has the capacity through its business operations. It still has the capacity, to earn exactly the same amount, in these different economic conditions. The fact that some of its assets are paid for with debt doesn't affect the marketability of its products. It doesn't affect the price of its products. Those are subject to just the market conditions and the underlying cost structure of the firm, the type of business that it's operating. Those earnings are based on the real activities that it's taking on in the real economy. The financing is just what's happening in the background in terms of who's paying for the capital and the resources that are being employed in the process of doing that that kind of business. So the earnings, that's all to say, the earnings before interest are unchanged in the new capital structure. But the percentages that these earnings represent of equity are going to change because the equity portion is actually smaller now. So the key point here, so we still have return on assets of 5%, 15%, and 25%, because the underlying value of the assets is still the same. There's still $8,000 of assets. It's just been split up in terms of the financing of those assets. And then we have a 10%, I should just remind everybody, we're working under the assumption that our cost of debt or the interest rate is 10%, right? So that's the cost of the debt. That's the extra money you have to pay back every year as a result of making that borrowing. So you're borrowing $4,000 at 10%. That leaves you with $400 of interest. That's something that you have to pay back regardless of the state of the world, regardless of what the state of the economy is. So that gets subtracted off of earnings. So you take earnings before interest, subtract off interest, and then you get after interest earnings. And that's what's then available to pay out to shareholders. That's what's then going to be, sort of the capital gain or the income, the extra flow to shareholders as a result of owning a piece of those cash flows of the firm. That's what a share of a firm is, just a claim on a future cash flow of the firm. So earnings after interest in each of these three cases, 800 in the expected sort of normal economic conditions, 1,600 after interest in expansion conditions where conditions are really good. And then earnings after interest are actually zero because the earnings before interest actually equal the interest payments. And so after you're obligated to pay your interest payments, provided that the cash is available to do so. And so those $400 of before interest payments all go to bondholders. And in that recession scenario, it turns out there's nothing left for shareholders after those interest payments are made. So that changes the risk and return profile. This capital structure, this splitting up of the financing between debt and equity changes both the the risk and as well as the expected return to shareholders. So now this is the key column here where we think about return on equity. In this case, equity is $4,000. Earnings after interest, that's what's available to equity holders. That's after you've paid off your bondholders, you have this 800 of after interest earnings. So that's, you think about ROE, return on equity, being, this $800 of after interest earnings divided by $4,000 of, the equity portion of the financing. And, that comes to a 20% return. So of the money that equity holders themselves put in, that's $4,000. The money that equity holders get to take home, that's $800. And so overall, there's a 20% return on equity. It's just the earnings after interest divided by the equity stake in the firm. So the return on equity increases after we do that borrowing, and then the earnings per share also increases. We have, if you remember, it was $1 per share, $3 per share, and $5 per share in the unlevered case, and now we have an increase in the expected earnings per share. On average, the earnings per share are higher, but the spread has gotten wider. Now there's now an $8 spread between the low outcome and the high outcome, whereas before there was only a $4 spread. So this just tells us a little bit of something about the nature of this debt financing and how capital structure affects returns. It has the potential to affect overall returns, but it also has the potential to affect the variability of returns, or the range of possible outcomes for equity holders. So this is a graph that I kind of had plotted before. This comes from just plotting, earnings per share on the y-axis, earnings after interest, earnings before interest on the x-axis. And what happens, this red line, or the blue line, I'll say first, is the blue line is the unlevered case, and the red line is the levered case. So the taking on leverage, it sort of represents a counterclockwise rotation of this line, of this plot that represents the earnings before interest versus earnings per share. Levering up sort of rotates this line in the counterclockwise direction, which makes makes the payoffs, when times are good, it makes the payoffs higher. You get a higher payoff in good economic times, but you also reduce your payoff in bad economic times. You essentially are increasing your payoff when times are good, but decreasing your payoff when times are bad. Just kind of making the overall profile of your investment more risky, or at least the part of your investment that you get to take home after you pay your debts, that portion becomes more risky. And so you can think about this, levering up. It's almost like you have a seesaw here, where the fulcrum is sitting here, and leverage just kind of rotates this curve around the fulcrum of this lever, or fulcrum of this seesaw, where you take your existing earnings potential. Nothing changes about your actual business practices or the capacity of your assets to generate products that people want to buy. Nothing changes about those underlying factors. You just sort of rotate that curve, increasing your potential for high payoffs, but also increasing your potential for losses and particularly low payoffs. So that's kind of a diagram just to kind of help illustrate this point of the trade-off between risk and return that's involved when you're taking on extra debt. I'll just mention too one thing. If we think about what this fulcrum is, this pivot point of this line is at $800 of before interest earnings. If we remember what that is as a percentage of our assets, that's 10% of our assets. So that's like a 10% return. And if we remember from the parameters of this problem, this 10% was equal to the cost of debt. So essentially, this $800 represents the point at which you're earning enough to make up the cost of debt. You're earning enough to be able to pay that cost of debt. So whenever you earn in states of the world or in states of the economy where you earn above and beyond your cost of debt, leverage is good for you. That's the portion of this curve that's above this 10%. If you earn more than 10% on your assets, then leverage can help you. You can actually increase your returns to equity. But in cases where you earn less than your cost of debt, in cases where the economy is in a recession and you sell a lot less than you're expecting, and it's not enough to cover your cost of debt, that's the portion of the curve, down here to the southwest. When you don't earn your cost of debt, then leverage actually puts you at a disadvantage. It makes you earn less of a return to equity compared to what you could if you were in an unlevered case. So that's kind of hopefully a helpful diagram. You get a little bit of an analogy from physics to think about how debt changes the relative risk and returns. So this is a table that just represents exactly what was in that diagram. We have kind of average or sort of a narrow band of possibilities under an unleveraged case. That's the first case. The unlevered case, you have a narrow band of possibilities. Leverage sort of expands the range of possibilities, makes the possible payoffs wider. And in doing so, it also increases the expected value, but not without creating extra risk. So we left off with this question last time of which of these capital structures is better. So we're going to get to that next. This has to do with, or this concept was investigated and sort of worked out in theory a long time ago in the late 50s by Franco Modigliani and Merton Miller. These were a couple of financial economists who did some serious thinking about this problem and worked out a solution that sort of holds under idealized conditions. So these are highly idealized conditions, these assumptions, but it's helpful to simplify matters and just get to the core elements of what's going on when a firm is borrowing, and consider what in theory is the debt actually doing for the firm. And so this first proposition, Franco Modigliani's and Merton Miller's first proposition, has to do with what the overall firm value is when investors have access to the same borrowing opportunities as the firm does. That's this first point. The corporations and the investors themselves have access to the same credit markets to borrow at the same rate. We're going to assume there's no taxes, and we're going to assume that it's frictionless trading. There's no friction. There's nothing stopping people from, if they want to buy shares in a firm, they can just do so without any extra fees or costs to them, or no extra um, time involved with that. It's just, it can be instantaneous and immediate according to what the payoffs of those decisions are. The result, I'll just mention the result just to preview this. Under these idealized conditions, it's actually, we're going to find that it's the case that it's impossible for the firm to change its underlying value simply with changing its capital structure, in the absence of taxes at least. And if we remember what the WACC equation says, we have these two components, one of them being the cost of equity. In module 8, or in lesson 8, we talked about how that's a result of the stock's beta. You know, the beta of the returns affects the required return of that equity. The cost of debt, that was just given by the yield to maturity on the bonds. That has to do with just the prevailing interest rates in the economy, the credit markets in the economy. That's sort of outside of the firm's control. It has to do with, you know, tax rates in the event that there are taxes. And so if you look at this equation, it might appear that you might be able to, you know, change your WACC or change your cost of capital by changing the share of your firm that is equity financed versus debt finance. You know, these are the shares, equity share. This is the debt share. It would appear that if you change those shares, if you change those parameters, that, you know, this term would get lower, this term would get higher, and so that would change the overall WACC, the overall cost of capital that the firm would face. One of the key things that makes that not exactly so. One of the things that makes it so that just simply changing these equity shares and debt shares doesn't, at the end of the day, change the firm's cost of capital. The reason that is that, as we kind of saw in that last example, the returns can change with leverage, but the risk also changes. And so one of the key insights, of course, when we saw this in the capital asset pricing model, we saw how, you know, extra risk, if an asset is extra risky, that's not free. That has to come at a cost. That requires that you have a higher return. Assets that have a high beta, that have a greater positive movements when the market is good, but greater negative movements when the market is bad, those sorts of assets require a higher return. Investors expect a higher return to take on some of that volatility. The same thing is true when you think about a single firm and their leverage possibilities. So when a firm takes on leverage, we saw the way that affects the risk profile of the returns. It makes returns higher, but also potentially lower. And essentially that characteristic of making the firm's returns riskier actually has a cost, and then actually that extra risk actually increases the required return of the firm. So it's the cost of equity gets more expensive as the range or the variance of equity returns gets more risky. And those two factors, in some sense, cancel each other out, where the extra return you get from having more risk is exactly compensated for by the fact that you're going to be required to pay for that extra risk by having a higher expected return. So there's more risk, and there's also the fact that you know, a firm that's levered up is sort of obligating itself to pay off certain loads of cash to bondholders before they ever pay their equity holders, and so it sort of in that way it sort of dilutes the value of equity because it siphons off cash that would have otherwise been available for equity holders. It sends it off to debt holders first, and then the equity holders are what are the people that get the returns after the debt holders have been paid in full. So those are sort of two reasons for why we have this non-independence. You know, the key point here, we have RS, RB, not independent of capital structure. The way that this equation is written, it looks like these parameters are just independent. You can move S or B. You can wiggle those parameters around, but in doing so, you actually change RS. In particular, you change RS. You change the required return on equity. So let's look at an example. So that's one way to think about it. Risk has to be compensated with higher expected return, and so one way to think about this is that higher expected return exactly compensates the extra risk, and so there's really, at the end of the day, no overall benefit to leverage. Another way that we can think about the way that investors themselves are actually indifferent between how leveraged a firm is we can think about what the investors themselves could do to lever themselves up and actually invest in the firm using their own borrowed money. Let's look at an example of how they could possibly take advantage of credit markets themselves in order to duplicate the returns of a levered firm. So that's this next example. So we're going to consider this same company, and we're going to consider an investor. So this is from the perspective of an investor. Let's think about two different strategies. The first strategy, we'll call this strategy A. You can take this firm, which has equity. In this case, the levered firm had, I believe it was, what did we have for the levered firm had 200 outstanding shares of equity. The unlevered firm had 400 outstanding shares of equity. Each of these had a share price of $20 per share. And so we're going to consider what happens when an investor takes his own money or her own money to these capital markets and makes some of these investments. Strategy A, buy 100 shares of levered equity. So remember the levered equity, that's going to be the version of the firm in which its payoffs have been sort of levered up. It's going to be the payoffs that correspond to this scenario where you get these kinds of payoffs under different states of the world. We ended up seeing that those are going to involve $0 per share, $4 per share, or $8 per share in different states of the economy. So those are the returns that a particular investor is going to be earning as a result of making an investment in this firm. So he buys 100 shares of levered equity. His potential returns are given by this top row, either $4, $0 per share, $4 per share, or $8 per share. And then earnings, as a result of those per share earnings, we remember that he has 100 shares, and we remember that in the event that he has 100 shares, then his overall payoffs, what he's entitled to as a result of owning those 100 shares, is either $0, $400, or $800 in any of these particular states of the world. So those are his earnings. His earnings are potentially 0, 400, or 800. And then his cost is $100, times $20 per share. And so that's going to cost him $2,000 to make this investment. So that's that's $400 at a $400 of return at a $2,000 investment. That's a 20% rate of return. So that's like the return on equity number that we had calculated before. That's the return on equity in the average expected economic conditions, and then it could be much higher in an expansion or lower in a recession. That's strategy A. So we're calling this strategy A. Okay. Strategy B. Let's think about an investor who maybe he doesn't have access to this levered firm. This strategy A involves investing in a levered firm. Well, let's say that there's an identical firm. There's two firms that are both identical. One of them is leveraged. One of them is not leveraged. Let's consider what an investor could do just by investing in the unlevered firm. So in this case, we're going to have the investor borrow, and this is going to have some of the same characteristics of the problem that we talked about with the blackjack player, who in one case took all of his own money to the table and played blackjack, versus the case where he borrowed half the money, played blackjack, and then paid off his bondholders or the people he had borrowed the money from. He paid them off before he was able to take his own money. This is going to be a similar type of problem for this investor, where he's going to borrow, in this case, $2,000 at 10%. So he's going to face, that was one of our initial assumptions, he's going to face the same interest rate as the firm overall. He's going to borrow $2,000, and he's going to use that $2,000 of borrowed money and supplement it with $2,000 of his own money in order to buy 200 shares in the unlevered firm. And so this strategy is called homemade leverage, because the investor himself, his actual investments are not levered up. The stock or the equity of the firm that he's investing in is not levered up. The firm hasn't borrowed, but instead the investor is actually replicating the returns to what that stock would be if the firm was levered up. So he's sort of, instead of the firm borrowing and the investor investing in the levered firm, the firm is not borrowing, but the investor is borrowing to invest in the unlevered firm. So $2,000 of borrowed money, $2,000 of this person's own money. So in this case, he's buying 200 shares, and he has the payoffs now. Remember, we're in the unlevered firm case. So the payoffs we're back to those kind of more narrow band of payoffs in terms of earnings per share. We're back in a world where there's a narrower band of payoffs. So these are the different earnings per share values that this investor is going to face under different states of the world. We can consider what those would each be under this ownership of 200 shares. So he has 200 shares. He's able to essentially earn these amounts per share. And so his overall earnings, as a result of owning these 200 shares, those earnings become these numbers here: 200 in a recession, 600 on average or in a normal conditions, and then 1,000 in expansion conditions. And then he's paying back. Remember, he borrowed $2,000 at 10%, and so that's going to entail $200 of interest. So that's what's in this this third row are the interest payments that this investor is obligated to pay as a result of this borrowing of $2,000. And now we see that if we take his earnings per 200 shares, if we take his earnings per 200 shares and we subtract off the interest payments, we get something that looks like the following. There's something that looks like what's in this bottom row here. $0 net earnings after interest, $0 in a recession, $400 in normal economic conditions, and then $800 overall in expansion conditions. Okay, and now the cost of this, if we think about the cost of this, he spent, 200, he's bought 200 shares. Those have costed him $20 per share. So that's a total expenditure of $4,000. And then half of this actually wasn't his own money. Half of this was the borrowed money. And so if we take off the amount that he borrowed, remember he has to pay that back, but that wasn't actually his own money to begin with. We subtract off that borrowed money, we end up with an overall cost to this investor of $2,000. And this includes the interest payments that he had to pay. So of course, borrowing this money wasn't free. It wasn't free to this investor to just be able to use this $2,000 to invest in this stock. But he's already paid for that. We already paid for that right here. So the cost of that debt is already baked into these earnings calculations, where he has to pay this $200 of interest for the ability to have used that $2,000 to begin with. So that's where the interest, the cost of debt's already baked in. It's already been accounted for in these payoffs. And so at the end of the day, it's really $200. It's $200 of this guy's own money, or sorry, $2,000 of this guy's own money, in order to generate payoffs that were either $0 or $400 or $800. That's strategy B. All right, so we can summarize. What those payoffs are on this next slide. We have strategy A. We have the payoffs to strategy A being 0 in a recession, 400 in average conditions, and then 800 in an expansion. We have strategy B, which, as it turns out, if we go back and look at these payoffs, these payoffs under each of these different scenarios turned out to be identical. So the use of homemade leverage actually was able to perfectly replicate the returns of investing just in a firm that had done the borrowing itself. And then the costs, we took account of those costs. We had $2,000 of the investor's own money, which was at stake in strategy B. We also had $2,000 of his own money in strategy A. And so these two different kinds of investments actually entailed exactly the same costs as well. So we have two different strategies that cost exactly the same, and that pay off exactly the same amounts. Not only do they have the same average returns, they have the same variance of returns. They have exactly the same payoffs under any state of the world, anything, whether it's a recession or normal conditions or an expansion. Those pay off exactly the same. So that's the key summary the payoff and the cost summary of these different strategies. Those are summarized here. The costs are both 2,000 and the payoffs are both 0, 400, and 800 in these different states of the world. Right. So this is sort of an illustration of the way that this Modigliani and Miller's Proposition 1 plays out. So essentially what this proposition says, it doesn't matter whether the firm borrows money and the investor invests in a firm that's levered up, or whether the firm stays unleveraged and the investor levers himself up or herself up and then invests in the unlevered firm. Those strategies actually entail the identical payoffs for different those different scenarios actually have exactly the same payoffs and costs. And one way to think about that, just sort of getting back to our previous discussion of this risk and return concept, is that this extra risk is sort of the extra risk that's associated with a levered firm is sort of already gets sort of priced into the price of that stock. The price of that stock already reflects the extra risk associated with that borrowing. And so in that sense, it's impossible for the firm to borrow and generate any kind of extra returns above and beyond what an investor could just get him or herself. Remember, the investor has access to the same credit markets as the firm does, and so there's no risk return profile that the firm can produce by borrowing that the investor can't him or herself actually produce just by borrowing him or herself on their own credit markets and then making investments in an unleveraged firm. So the fact that both the investors and the firm have access to the same credit markets means that the investors can essentially replicate the returns of any firm. And so at the end of the day, under these conditions, under this no taxes, no transaction costs conditions, there's no net gain to having leverage, or leverage doesn't give shareholders anything extra that the shareholders themselves couldn't just get themselves by producing their own sort of homemade leverage. So that's kind of the idea behind this this first Modigliani and Miller proposition. We're at time for this class. My plan is to just keep plugging away with some of this capital structure stuff. There's a second proposition, a second Modigliani and Miller proposition. There's another case where we look at the same sort of problem, except where there's corporate taxes. And in that case, it actually, we'll notice that it actually does matter for the value of the firm, whether the firm borrows or not. But for now, this is where I'll stop today. Yeah, so we got a question in the chat about return on equity and return on debt. Let me go back to that. That's a good question. Yeah, this is the slide. So if we take this equation, this WACC equation at face value, and if we say that, you know, this RS, this return on equity, and RB, return on debt, and we take the tax rate as given, it appears that we can actually change the WACC by changing the shares of debt and equity. You know, if we decrease the equity share and we increase the debt share, then we're going to shrink this term here on the left. This S over S plus B is going to shrink. The B over S plus B is going to grow. And if RS and RB are constant while that's going on, then the firm has an ability to actually change its overall WACC. But if it's the case that if RS changes along with the equity share, then it's not necessarily the case that this WACC would change once you change your capital structure. And that's actually what we're going to see, just to kind of preview this next part. we're going to see that the change in S over S plus B in this WACC equation, if that goes down, that's actually exactly offset by an increase in RS. So the changing S over S plus B, changing the equity share, is going to influence S, or it's going to influence RS to the extent that those effects will actually exactly cancel each other out, and the WACC is going to turn out to be invariant to capital structure. If RS changes enough to compensate that change in S over S plus B, then we're in a world where WACC is actually completely independent of capital structure. And that's, if you've looked ahead at the textbook, you'll know that that's actually the case where WACC is invariant to capital structure under the conditions of no taxes and no transactions costs for investors, and under the assumption that investors have access to the same rate of borrowing as the firms themselves do. So Seamus, that was the concept there, which will tie into sort of this will get into Modigliani and Miller proposition 2. We just looked at proposition 1 about the firm value being invariant to the capital structure. Proposition 2 has to do with the cost of capital being invariant to capital structure, which actually that directly follows from proposition 1. That's sort of a logical implication of proposition 1. Okay, that looks like all the questions. Thanks for tuning in today. We'll see you guys on Wednesday.